After what we heard from Jay Powell, the fact that rates could eventually end up higher than previously expected, is it changing how you're managing your portfolio?
It's starting to make a change a bit, at least in terms of the short-term outlook. I think around this level of rates, we're starting to hit a bit of a danger zone. So typically when you get the 10-year over 4%, that starts to put some significant pressure on valuations. When you get these periods where Fed funds and the 10-year are converging, that starts to put some pressure on valuations. So I think in the short term, we definitely face a bit of a choppy market here. The potential good news is that we have two CPI reports between now and the next Fed meeting. So perhaps we get some progress there because that appears to be what is needed in order for the Fed to make a change in how they're communicating policy, is some clear, substantial evidence of improvement in inflation.
Yes, generally, the general wisdom here is that those two inflation reports can have a big impact on the Fed's decision. Looking right now at the futures, higher this morning, even though we're expecting unemployment to stay the same and some pretty big job gains. What's the market seeing that's making the futures go higher this morning ahead of this report that, in theory, is going to be, quote unquote, good, which will be bad for anybody that wants to see a pause or a pivot?
Yeah, it has been a very confusing time with a lot of conflicting messages. I think one of the pieces of good news that's good news on the job market, at least in my opinion, is that it buys the Fed a bit more time to solve inflation before recessionary conditions emerge. So you are seeing some weaknesses in some parts of the economy, but overall, the economy continues to grow, albeit at a slow rate. And as you noted, the jobs market continues to be very strong. And so I think that buys a bit of time for some of these inflation numbers to improve. So while they're not helping the inflation conditions by a strong job market, it's buying time for the rate hikes to work their way through and for conditions to ease normally, given that some of the reasons behind inflation had perhaps been caused by some of the problems in the pandemic. So we think it's good news that there's a strong job market buying some time for the Fed to solve inflation.
Wait, you think a strong job market buys time for the Fed? Because if the job market remains strong, doesn't that actually kind of keep the Fed on its course? It says it wants to get inflation down to 2%. Last read was 8%, a long way to go. Doesn't a strong jobs report actually make it more likely we might see that 75 basis point hike in December as opposed to the 50 basis point hike?
Sure, it does, and that's certainly what the Fed chair has been communicating in terms of what they're reacting to, and that certainly they would like to see a bit of a softer economy. And while they probably wouldn't say it this way, they would like to see a bit of a softer job market as well. So you're absolutely right in terms of that take and that interpretation, and I think that's correct. What I'm referencing is that each and every CPI report that we get is a chance for those numbers to come down a bit. Some of the things below the surface in CPI have been improving. So out of the last three reports, I think two of them have been decent and one was not so great. And so we'll see what the next two unfold. So if we get through the next two CPI reports with some progress on CPI and the job market being, let's call it stable, that's probably the way to thread the needle in terms of markets going forward.